everybody. It's such a delight to be back in Cape Town, and it's my third time. Each time is slightly growing in time. My first time, I believe, was less than 24 hours. This time I'm getting slightly longer than 24 hours. But yet I'm still to see much of what Cape Town and South Africa has to offer. So we switched the conversation a little bit, and I represent ICBC Standard. You could really understand ICBC Standard as a child of ICBC and Standard Bank. So as the offspring of our two stakeholders, what we do very much, and actually it's an exciting time to be representing China and Africa, ever more so than before. Everyone, all of the investors, I'm based in London, as you can tell from my accent, investors interested in two things when we talk to them. Emerging markets, China. China is no longer considered by many investors as an emerging market. But frankly speaking, what I may say in my presentation to you, a lot of the themes you may have heard of, but I wanted to connect particularly with the setting and the context of a lot of the African themes, continental themes we've talked about, and of course South Africa, which we just delved into. What I want to say is that, are we thinking about China and Africa in the right context? Are we really realizing the potential in the second largest economy in the world and potentially the biggest contribution not only to GDP, but also to people? Demographically, Africa is going to be producing the youthful population that we very much lack right now in the Western world. So just to unpack some of these themes, I wanted to start with something that we highlighted in our annual Outlook report, and that is the great reallocation. So in my presentation, I'm going to give you 3 Ds. My first D is diversification. Whoever you talk to, investors or corporates, the biggest thing that is on top of everyone's mind is diversification. What's driven that? Geopolitics, the differentiation in terms of markets, and the ever-seeking of safe haven assets. We used to think US Treasuries, but nothing, frankly, nowadays carries zero risk. But we could search for the next best thing, and what has happened is that global GDP growth profile, as you see from the slides here, has shifted away from advanced economies towards emerging markets. And what we will witness in the next 5 years, according to IMF projections, is that for the first time, emerging markets will not only overtake advanced economies in terms of GDP contribution, but also in absolute GDP size. So what I'm asking is that we are so used to talking about China and Africa being the biggest contributions to growth, particularly after financial crisis, because obviously there's a lot of room for growth, lots of reforms, lots of industrialization and urbanization to go. But really, do we understand where allocation of reserves, investment, capital is properly aligned with what this story is telling us? Are we looking at our portfolios and reserves to align with the current mapping of global growth? And the answer is no. Whether you talk to foreign institutional, sophisticated investors in Europe, in the US, when you ask them how much of your portfolio are in EMs or in China, minority. When you ask similarly the question back to Chinese investors, sovereign investors, how much of your portfolio is invested into emerging markets or non-Chinese assets? Very little. So I guess the story of diversification is not just, trying to understand how global asset reallocation back into China and growing markets, but also the other way around in terms of how we can also make sure that Asian and particularly Chinese sovereign allocation is also naturally flowing into emerging markets, in particular Africa, whom China now increasingly trade with, invest with and into. And this is one of the themes, and I think will start to really question whether the allocation of reserves, capital portfolios are adequately looking at the alignment and what the global themes are telling us. So what we are seeing in official data is a switch away from dollar-denominated assets, including equities, fixed income, etc., into gold, mainly because of that safe haven status that I talked about, and mainly driven by central banks, but also into RMB denominated assets, so that red line you're seeing. So that is not a proportion, by the way, that is absolute amount, mainly because it features so little right now in terms of global, so still below 5% of global reserves. Let me talk a little bit more about the gold reserves, because as we can see from news flow, etc., a lot of central banks are piling into gold. And again, the current geopolitical dynamics mean that this trend will probably continue. Same across Asia, in Africa, and we see actually as a proportion of overall FX allocation, emerging markets actually allocate more into gold than many other advanced economy central banks as a proportion of total FX reserves. And that is really because the fear of depreciation of the currency, for example, traditionally, but also the underweight of, in absolute terms, into gold. So we see more gold purchases, particularly from emerging market central banks, and that includes China. And we see not only central bank demand, but also jewelry and consumer demand as well into gold and other precious metals. So diversification carries another meaning. And now I'm going to talk a little bit more about China's macroeconomics and where that growth came from. So in the previous panel, we heard so much about how South Africa is looking for where that growth is going to come from. In China, actually a very similar story. We're used to double-digit growth, fast growth in China. But actually, there is now less focus on the scale or the quantity of that growth. It's now about the quality of growth. So my message to South Africa and Africa is that maybe you can avoid some of the pitfalls that China made by actually thinking every single 1% of GDP growth, how much value does that deliver for the development of my economy? What is the quality of that growth to its people, to the corporates, and the dynamism that Africa has to offer? So in China, the story currently is that there is a relatively unbalanced profile when it comes to composition of GDP growth. China traditionally has been investment-led. Regardless of what media tells you, which is that China is export-led, that is not the case. And really, China's success in GDP growth comes from the fact that government-related investments, particularly central government, SOEs, which is quasi-central government, lead growth. If you say that Africa is, resembling of local governments in China, but essentially there's one government leads, you're probably in a position where there is a central allocation of resources and investment. But China is very unique. China works in 5-year plans, and currently we're heading into the 15th 5-year plan. Now, next week will probably be one of the most important meetings in a second largest economy. It's the 2 sessions meeting. Every year, China in Beijing, there is a convening of the annual budget meeting where economic targets are announced, work report is being reviewed, but very little is talked about because people, especially I think media, it doesn't pick up headlines of what it means. But next week is the first 2 sessions in the current 15th 5-year plan. What does that mean? It doesn't just mean China will deliver its vision. For the rest of the world, especially the southern world, emerging market, we need to understand what China will be investing, where the flows will be going towards, and how China will trade and invest with the rest of the world, particularly the emerging world. So in a nutshell, the challenge facing China is not the quantity of growth. Whether the growth target remains 4.5 or 5% is irrelevant in an economist's view, because every single percentage of that growth needs to now deliver productivity. We are used to China being stimulated by construction activity, property-led investment activity, but those traditional sectors no longer lead GDP growth in China, and I'll have a slide later on to explain why. So this chart gives you a little bit of insight into what the 15th five-year plan means. And I can safely say I read it again. I read it all the time when I give presentations all over the world. But again, if you read the components of what the 15th five-year plan entails, it has every theme we've touched upon since yesterday. It goes into the importance of new technology, so away from traditional construction sectors towards more capital-intensive, new technology, the fourth industrialization, whatever you want to call it. But this essentially means China is seeking a higher quality of growth at the time when China's population is declining. So likely that labor-intensive industries will start to lose productivity. So the age of AI and the age of fourth industrialization is not a wishful thinking from China. It is actually a necessity. And the way that I look at why we think China has already shifted to the new economy, no longer the traditional growth model, is in fact, if you look at the components of some of these high-frequency indicators, and here we use the Caixin New Economy Index, is that a lot of the transformation and the industrial upgrading has meant that there's already been a lot of focus in capital investment versus labor input. And what we see is immediately in the equity markets. Post-Lunar New Year, we've seen another bout of bullishness in the onshore markets. And the reason being not only the blanket tariffs is actually beneficial for China because it sees a lower rate than previously expected from the US, but also the fruits are starting to really bear fruit in terms of the investments put into some of those new economy industries, high-end manufacturing, logistics, robotics. All of these industries, a lot of emerging markets are starting to think about, but China is already there, not only in terms of initial investment, but in terms of providing the jobs, making sure that SMEs and private sector have access to funding to be successful in those new industries. And then secondly, I want to give you my second D here. So we had diversification. Second D is dynamic policy making. And the reason for dynamic policy making, when we talk about global interest rates, it's important to understand that benchmark interest rates in China hasn't worked super well because China is still not yet a consumption-led economy whereby people use credit cards in order to consume. So just by lowering rates is not going to stimulate consumption. So the number one challenge for China is how to unlock savings and actually stimulate domestic consumption. So lowering benchmark rates has not had that effect. So what the PBOC has shifted to is this, first of all, very much a corridor effect. So different policy rates for different sectors of economy to deliver the ample liquidity that the PBOC constantly pushes to the relevant sectors, to the real economy, where it really is needed. And there's an 8-part measure. So a lot of this is not well understood by markets because a lot of this is really buried inside a lot of regulatory announcements. But in fact, a lot of that 8-point measure is focused at making sure the most vulnerable sectors, whether it's agriculture, carbon reduction tools for sustainability purposes, the services consumption, elderly care, these are more social welfare sectors rather than simply putting out or pumping through the liquidity at low cost of funding. So dynamic policy making has really been the key to success. Now, I've summarized a few data on China's interaction with China, but obviously we've heard a lot about it. But the key for me here is in the stock of investment with Africa. Obviously, I love to have the time to delve into specific countries, but as a continent, the good story here is not just about the scale of flows of trade and investment, but about the diversified nature of the sectors. So construction, mining, manufacturing, fair enough, but also others are coming through. And I think that in the coming years, we're going to see much, much more sectors coming into fruit. And then one last point, which I don't think is on this slide, but certainly in terms of how such investments are financed. China and Africa story used to be very much bank credit financed. However, China has shifted away from that traditional funding model too, to encourage private equity, joint investment, particularly with development organizations, to and partner with other institutions to invest in Africa. And similarly, the other way, the flow should also be bilateral, because I do believe there is a lot of opportunities, particularly in renewable industries, high-end manufacturing, where there's lots of synergy between China and Africa. And this is particularly true as China is now fully integrated in the global supply chain. So remember I said China is not export-driven. It's because China is a nation that imports to export. So it's a processing trade. So this doesn't mean that China is consuming more or exporting more. It certainly means that China is deeper and deeper integrated into the global supply chain. Almost everything you touch, see, goes through China, but doesn't necessarily end up in China, nor does it originate in China. So we need to understand that trade dynamic better. Currency. So my last point is about debt sustainability, but not in the way that mainly we talk about it from a national level. But actually, debt doesn't have to be all bad, because the current theme is that Chinese currency, RMB, is appreciating. And currently, the softer dollar is helping that. But the key thing is that cost of funding is low. So in reality, fundamentals mean there is now more and more opportunities in the RMB market, both in terms of investment and funding. So my final message as my time runs out is that whether you're a corporate, a government, a Ministry of Finance, whether you're just an observer, do we understand the formats of funding, both offshore and onshore in RMB? So offshore CNH, onshore CNY. Panda, onshore, offshore, dim sum. And the reason being is that often or not, both channels of funding are very low, lower than hard currency funding. Very little tapped. But the beauty of this market is that Chinese investors are looking for RMB denominated assets. But there's not enough issuers in these markets. So my message this year, which is probably a little bit different from last year, because the funding in dim sum has not become interesting until now. Chinese investors actually are looking for RMB denominated assets, but increasingly looking at how to align with the global story of emerging markets. You may have heard of Belt and Road, for example, however you like to call it. But the way that portfolios are starting to shape in China too, as well as the Western investors, is to more align where the growth is. So again, my concluding remarks really is that diversification, not only for the West, also for China, also for emerging markets. Secondly, dynamic policy making. Dynamic policy making is exactly why China has not followed many other major banks, but actually sought its own path to make sure that dynamic policy making fits China's own model. And last but not least is debt sustainability. Not that China is indebted to the extent that it cannot finance it, but actually I'm talking about, are we looking at debt in using the right instruments and the right channels? RMB is probably not on everyone's wish list, but have we started to explore it as part of your diversification journey when it comes to debt sustainability? So thank you very much for listening. I'm here if you have any questions, and I look forward to meeting all of you. Thank you.